Welcome to the West One webinar, and I appreciate you taking the time to join us today. With me is James Humphreys, our Head of Valuation, and Sid Radia, the Head of Group Servicing. Today we are looking at how West One works, how we can offer investors short-term property-backed loans, and how investors can then diversify their investment portfolios to mitigate against risk. If you have any questions, please drop us a line during the webinar and we will endeavour to answer at the end. Firstly, I'm going to give you a little bit of background information about West One to provide a fuller understanding of where we sit in the market and the resource and manpower that we can utilise. We are part of NRES Specialist Finance and have been a bridging lender since 2007. We have lent 4.2 billion to date through the West One brand, which covers bridging, second charge mortgages, development finance and buy-to-let mortgages. The group also benefits from having two master brokers, Enterprise Finance and Vantage Finance, who provide a steady stream of loan opportunities to us, as well as, in certain cases, reviewing exits for the borrowers. The past months have been challenging for all with the pandemic, and at West One we have remained resilient, adapted accordingly, been prudent with our lending decisions and evolved accordingly. Demand for bridging loans is strong within the UK residential market, boosted not only by the budget changes, but stamp duty extension and the planning bill, which will simplify and speed up the planning process, which means that bridging will continue to grow in the foreseeable future. Today, I'm going to concentrate on the bridging side of the business, as this is the area that is funded by our bank of professional investors. What do? We bring together borrowers in need of short-term lending with funding investors who are willing to lend on this type of property. Who are our investors? Our investor base is made up of over 700 elective professionals or professional per se individuals who have a good understanding of property and investing and who understand the risks. Our investor base is varied and is made up of property investors, partners at major law firms, bankers, alongside small family offices, charities and pension funds. Often investors open more than one investment vehicle with us, such as investing under their company name or through their pension, trust accounts for grandchildren. However, we do not offer advice and you should speak to your IFA or accountant as to the best investment entity for you. Who takes a bridging loan? One of the first questions I often get asked are, who are our borrowers? Why would someone take what is considered an expensive bridging loan? Well, as you can see, we have different types of borrowers. Jack, who is looking to raise funds to repay family and fund the planning process. Rachel, who is bought at auction and looking to refurbish and refinance to a buy-to-let product. And Amir, who is looking to purchase something extremely quickly. A bridging loan for these borrowers will provide the funds and allows the borrower the flexibility that a long-term loan, albeit at lower rates, does not. Bridging finance fills the gap. Major financial institutions are not geared up to provide access to funds quickly enough. Borrowers can repay the bridging facility early without penalty. That's how we can compete with the high street. And in most cases, interest is retained during the term so that the borrower can concentrate on their project without worrying about cash flows. Retained interest is something that we look at later, as this is something that is also of interest to the investors. So, the next set of questions that I get asked is, what are the returns and how does investing through the West One platform compare with other investments in the marketplace? Well, this past year is certainly an anomaly and one that has been difficult for all to navigate through. However, the returns from bridging have been consistent, whereas alternative investments have seen falls. What West One bridging does provide for an investor is a monthly return. As long as we receive funds, you receive a return. You are not waiting until maturity for loans to pay out in full to receive your share of interest. Looking at the annualised return, and if investors take a portfolio of different loans, then they are seeing returns of between 7 to 9%. However, this does depend on your loan selection. The key investment features, well, it's 25k per loan opportunity and we suggest at least 100k as a minimum small portfolio. The average loan size is around 600k, and all investors rank pari passu. So this could be filled with 24 investors all placing 25k in the facility, or 6 investors each committing 100,000. The average loan to value is 60%, though I must say this is actually coming down due to our prudent lending in this current time. And all valuations are based on 180-day valuation rather than open market price, giving us a bit more wiggle room when it comes to the value. How does the process work? Well, West One Loans will act as a conduit for your funds. We do the underwriting and management of the facility and take a management fee for our services. The management fee ranges from 22.5% to 30%, dependent against the 180-day valuation. The higher the LTV, the lower the management fee, to give investors a higher return for their risk. Again, LTV is only one of the factors to take into consideration when looking at risk. It's up to you to decide what you are comfortable with. For example, a loan at 70% loan to value to a borrower we have worked with previously may have a very clear exit with an AIP from another lender, whereas a loan at 55% loan to value may be dependent on a sale and be to someone we have no relationship with. The risk profile is clearly different, and it is up to you on reviewing the term sheet and valuation whether you wish to invest. Let me give you a quick overview of the process before getting down to more granular detail. We originate the loan, underwrite and price the facility. We send you the loan opportunity. You decide whether it fits your criteria and are happy to lend. We manage the servicing and collect interest. We then pay you monthly interest on the 9th or 10th of the month as long as we receive it. The loan redeems at the end of the term and you get back your capital. Even more so at this current time, everything is reliant on the property value, and you can see the process that each loan goes through before getting the green light. From underwriting assessment, valuation by an external risk valuer, asset manager's overview to credit committee. James will take you through this in more detail shortly, but what does set West One Loans apart from other bridges is the fact that we do have our own internal team of risk valuers. So, let's get down to how it actually works. Once the underwriting team have carried out their due diligence and the solicitors tell us that the loan is ready to fund, the first time an investor will hear about a loan opportunity is when we email you a loan overview with all the salient points. Due to GDPR requirements, you do need to log on to your investor portal to see a full term sheet and a copy of the valuation. But if you are not interested from this loan overview, then obviously you need to take no action. As you can see on the loan overview, it does give you the salient points. It tells you the loan amount, where the security is, your annualized return, the loan to value based on the 180-day and the term, and it will give you an idea of the exit and whether interest is retained or not. So I'll just take you through the full term sheet. As you can see, there is far more detail than on the loan overview you previously saw. You can see the full loan amount, the borrower's name, the full security address, and the nature of the security, as well as the valuation. You can see a bit more detail about the exit. You can also see the rate that we charge the borrower and then the rate that we charge and give to the investors. You can also see the rate that we charge the borrower and the return that the investors will see. I mentioned earlier retained interest, and as you can see, retained interest is detailed here for 91,200, and each month a 12th of that will be moved across from one of our client accounts into another client account to pay investors their monthly return. As I mentioned previously, this is game which sets us apart from other investments. You are not awaiting until term end to get some funds back from your investment. This is another term sheet showing you the types of loans that we offer. As you can see, Day one, we are not offering the full amount that we have agreed to lend to the borrower. Just because you've committed to participate at the first stage doesn't mean you have to contribute to further drawdowns. You can stay at your pre-agreed level. As you can see, this one happens to be a commercial loan opportunity awaiting planning permission. Again, you can see the rates to the borrower, the rate to yourself, and obviously your monthly return. The online portal that you use to access these loan opportunities is also used as a storage facilities. It also details some important KPIs so you can keep an eye on your investments. You can actually give your accountant read-only access, or if you're investing as a partnership, both of you can have full access, but it does allow you to keep track of your own portfolio. So, dependent on your loan selection, you really can choose a balanced, diversified portfolio of loans, whether based on LTV, area, property type, or purely rate driven. However, as it is property and exits can change due to external circumstances, you do need to have a certain amount of flexibility with regards to timings of redemptions. As all the facilities are backed on property values, investors do have to feel comfortable with the underwriting and value of the security. Having our own internal team of risk valuers set West One apart from other bridges. So we'll now pass you over to James to take you through how his team assist the underwriters and work with the servicing department throughout the recovery process.
Thank you, Cheryl. Hi all. I'm going to give you an overview of who I am, what my team do, examples of what we're working on and what we're seeing in the market at the moment. I'm a chartered surveyor with 19 years post-qualification experience. I came into the business just over 2 years ago now, having most recently worked in private practice in central London. When I came into the business, it was a new role to West One. It quickly became apparent that having an in-house property team was hugely beneficial, both as a front-end audit and panel management function and also providing the capacity to bring the back-end asset management function in-house. My team now comprises 3 chartered surveyors, including myself, and also an administrator. The other 2 chartered surveyors are both individuals I've worked with previously. We have varied experience, including prime central London residential, wide-ranging commercial property, and also in property development, giving the team well-rounded skill sets and expertise. From an origination point of view, we audit and review all high-value assets and keep a tight rein on the external valuers we use. Carrying out the back-end asset management function not only provides additional control and allows for significant cost savings, it allows my team to apply lessons learned in new underwriting decisions going forward. My team are directly managing numerous assets from the point of possession through to sale. These assets range from straightforward average priced residential properties, high value prime central London houses through to development sites. When an unfinished development site is taken into possession, either via a receiver or directly by us, if there's an opportunity to step in and complete the works to ensure maximum recovery for investors and West One, we will, and we have the skills and experience in-house to do it. By way of examples to demonstrate the work we are doing, last spring we took possession of a house in prime central London valued at origination in the £5 to £10 million price bracket. On obtaining possession, the condition was poor, having been neglected by the borrower for some time. Prior to placing on the market, we carried out a light refurb to freshen the house, to include repainting internally, sanding, treating floors, as well as dressing the house. On going to the market, it did receive interest, initially with 2 offers at acceptable levels, but neither progressed. During the autumn and winter last year, interest dried up, not least due to COVID restrictions and the lack of international buyers in the country at that time. Offers were being received, but at low levels. We then took the decision during the 3rd lockdown, and also due to the lack of market activity at that time, to inject further capital at West One's expense to professionally interior design the house inside and out, ready for when the market opened up. The result was instant. Within a week of completing the works, an offer was received and accepted from a buyer who had previously viewed the property last year and had rejected it at that time. Another example, we have a development in the southwest of 2 houses. The developer, our borrower, cut corners, failed to finish the 2 units and got into a major legal battle with a neighbour. Disposing of the site as is to a developer will result in significant capital loss. By completing the works and selling the 2 houses to end users, there is an opportunity to maximise our recovery. Therefore, the senior management team at West One have made the decision to invest significant funds to complete the works. Navin from my team is now project managing the works. He has put together an experienced local team of professionals and contractors, and as we stand, we expect the houses to be ready to market before the end of the summer. So what are we seeing in regards to the market? It's been widely reported in the press, including in the latest RICS housing market survey. There is a supply and demand imbalance pushing up prices. This is mirrored by what we're experiencing from £200,000 houses in the northwest to prime central London. However, I would caveat location, as ever, and now outside space are key. By way of an example, we have a development in the Midlands we are selling comprising 6 houses, some with private gardens, some with communal only gardens. We have had bidding wars on the units with the private gardens, while the communal garden only houses have had limited interest even at the lower price points. We are very conscious the current buoyant market may well not last into the autumn, so now is the time to close out sales on as much of the stock we are managing as possible. Thank you for your time, and I will now pass you back to Cheryl.
The servicing and recovery team is one area that has certainly been tested with numerous challenges over the past year, and will now hand you over to Sid to provide an overview of how they work.
Thanks, Cheryl. Good morning all. I'm Sid Radia. I head up our servicing department. This ultimately means I'm accountable for all loans across all products once they have paid out. To give you a bit of my background, I've been here at West One since January 2018. I've been in the finance industry for the last 25 years. 16 of those years were spent at GE Money, where I held numerous leadership roles, predominantly in collections and litigation. I was there during the 2008 recession, where my key focus was loss mitigation, delivering the recovery strategy and driving performance. I've also held roles at Kensington Mortgages, Barclays Bank and the Financial Services Compensation Scheme. To give you a bit of background regarding the servicing team, their main duties are to ensure customers maintain payments and redeem their loan on time. I've got 13 members in the team. Collectively, we have over 130 years experience in collections and servicing. We're responsible for all products, which include our second charge loans, our buy-to-lets and bridging loans. When I joined back in January 2018, there was 2 members of staff in the team. I was in a fortunate position to build the team and therefore called upon previous colleagues I've worked with who would have the relevant skill sets for the role that I needed filling. We have clear procedures in place. All staff members are aware of what is expected from them, and I regularly monitor their performance. So to give you some insights into what the last year and a half have looked like for the servicing team, given what we're all experiencing and going through, there's been strong regulatory guidance as to what we can do when it comes to possession proceedings, payment holidays that we must grant, and forbearance that we must demonstrate. For our seconds and buy-to-let portfolio, payment holidays was the thing. The guidance was we must give payment holidays. In the industry, the approximation of their portfolio is between 30 and 35% were on a payment holiday. At our peak, we hit 15%. This was much lower due to the approach that we took. Our approach was to talk to customers to understand their position, explain to them what a payment holiday meant, and this resulted in some customers wishing to continue making payment towards their loan. For our bridging portfolio, whilst we do a mix of regulated and unregulated loans, The guidance was to treat both sets in a similar way. Although we only granted 2 payment holidays, for the majority of customers, it was a case of working with them to ensure the debt doesn't increase and they have a clear path for redemption. As we know, there will always be some customers who cannot achieve this. For this very few population, we continue to try and find solutions for them, but where this was not possible, we had to wait for the courts to reopen ahead of commencing litigation. How we approach things today, we continue to work with our customers who have suffered as a result of COVID, and we have a clear strategy for them to work to, which is then monitored on a regular basis. The courts have reopened, and for those customers where no solution is possible, we have commenced action. The courts have slightly tweaked their process so they can prioritise the most urgent cases. They have a pre-hearing where no parties are required to attend, but a judge assesses the case and determines the priority. Where priority is highlighted, they will list the case for a possession hearing. We have submitted 6 cases to the courts, all of which have escalated to either a possession hearing or we have already been granted a possession order. We continue to use receivers where use of courts is not required. We utilise 4 receivers, all of which have different strengths. Dependent on the case, we will appoint the most appropriate receiver. The key to servicing is to identify early who needs help and who has limited intentions of redeeming. Our process is to call customers 4 months before their loan end date to establish their plan. This allows us to work on solutions, if needed, before they reach the end of their term. I hope this has given you some insight into the servicing department. Thank you.
Just to recap on how the flexibility of bridging loans can help build a balanced portfolio dependent on the following. Investment risk. Each loan is a small ring-fenced eighth and you select the loan according to your risk appetite. Liquidity risk. The average loan term is around 6 months, so you are reacting to the changing market. Funds are not tied up for years. Regulatory risk. We have a strong compliance team, and as we are also an on-balance sheet lender, we follow certain guideline criteria for all our lending. Servicing risk. As you have heard, we have a strong, extremely experienced team with a proven track record. Around 90% of the loan book performs as it should. What investors remember is those that unfortunately do not go according to plan. We have completed over 2,000 loans to date and repossessed around 40 properties. This may increase slightly now that the courts are reopened. With this type of investment, one does need to be flexible. Just because the loan end date stated 30th of October, this does not mean it will redeem on time. It can redeem early in June, in which case you get your funds back and get offered other loan opportunities. The borrower may require an extension, not necessarily a bad thing. It could be due because it needs revised planning, and as mentioned by Sid, there are those that unfortunately we do need to repossess. We have a tried and tested path that we go through and communicate weekly through the portal to provide updates, but these things do take time, so especially in this climate. However, if you do take a portfolio of loans, you have other loans performing and redeeming as intended, and as lending to clients is over a short period, returns can be quickly realised with exposure minimised. The value of the properties used as security is higher than the investment amount and interest due. Therefore, funding bridging loans allows you to diversify an investment portfolio in an informed and constructive way. West One has built up a strong track record and has consistently been delivering returns to its investor base, who at the maturity of their investments most frequently elect to invest in new loans. However, the platform also provides the flexibility for those that dip in and out. Where do we go from here? Well, if you are interested in becoming part of the investor base, then we do need to classify you and carry out KYC. So please email me at cheryl.levy@westonloans.co.uk. Let me know if you are looking to invest as an individual or as part of a company, and we will issue 4 of the forms for completion. We can then arrange a time to get together either personally or via Zoom, and answer any additional concerns that you may have. We have received some questions that we have time to answer today, and any others that we don't get round to, we will endeavour to answer in the next day or so.